The Real Investment Show.
Right now, everything is telling us we're headed for a recession. We're headed for lower inflation. And if you're choosing between stocks and bonds, the winner is somewhat obvious.
When investing, we always have lots of choices about things that we can invest in. And unfortunately, the mainstream media kind of only focuses on one thing, right? Stocks. Right, it's the only investment class that we talk about because it's the sexy class, right? It's always exciting. Markets move up and down, and people are winning and losing fortunes on a daily basis. And so it makes for great headlines, but there's a lot of asset classes out there to invest in, and a good portfolio is one that has a diversification of assets across the board that allows for better risk mitigation. There's one of the problems that's been created by more than a decade of Federal Reserve interventions in terms of the markets has been this loss of the ability for people to understand how to manage risk. Stocks have simply gone up for 10 years. Why do I need to manage risk as long as the Fed is liquefying markets? And so this has led investors to really kind of forget about other asset classes that provide an ability to diversify risk in a portfolio and create returns. And one of the asset classes that is most misunderstood and really, in a lot of cases, not real educated about are bonds. And there's a lot of different types of bonds out there. And just like in the stock market, there's a lot of different types of stocks to invest in. You've got growth stocks, you've got value stocks, you've got preferred stocks. Well, in the bond market, it's the same thing, right? You have a variety of different bonds that you can invest in, and they have a different place in a portfolio. Each type of bond has a different place in your portfolio, and they have different reasons for owning them at different times. There are times where I may want to own one type of bond, but not another. And so what we're going to do today is just really go through kind of a basic education about what types of bonds are out there, how bonds work, and then the real focus of the conversation is why now? Why would we want to own bonds now, particularly as inflation is high and interest rates are going up? Why would I want to own bonds now? And what does that mean for the bond market in the future? And what can I expect from that in my portfolio going forward? So Michael Lebowitz, welcome to the show this morning. He's our resident bond expert. Used to work for Fannie Mae back in the day before they went bankrupt.
Wasn't my fault.
So let's start out very basic here, Mike, just because so many people don't understand what a bond is and how a bond works. Let's just start there. So let's take a very basic, simple example. A 10-year Treasury bond, and then we can talk about corporates and others. But how does a bond work, and what does that mean for somebody that buys a bond?
Let's make it even simpler. What is a bond? Lance comes to me and wants to borrow $100. I say, okay, I'll lend you $100, and you're going to pay me $105 a year from now. That we shake hands. That shaking of the hands is a bond. Now, we could do the same thing with IBM or Uncle Sam or anyone else, but instead of shaking hands, we exchange a legal document. That's the bond. So the bond is a shaking of the hands, a legal document. And let's think about this bond, shaking of the hand bonds that Lance and I are, this money lending that we're doing. I'm going to give him $100 today. He's going to give me $105 a year from now. That means that the coupon is 5%, means I'm going to earn 5%. It also means in this case, the yield is 5%. And that works for U.S. Treasuries, for corporate bonds, slightly different for mortgage-backed securities, but any type of loan, whether it's to the British government, Uncle Sam, a very small company, the biggest of companies, Apple, they're all bonds. And what makes a bond unique versus a loan with Lance is it's tradable. So if let's say instead of Lance, we bought a bond, and that bond pays 5% interest for 1 year. And instead of paying at maturity, so instead of paying Lance 105, or instead of Lance paying me 105, I'm going to lend the money $100 today, and I'm going to get half of the coupon in 6 months. So I'll get a check for $2.50. And then at maturity, I'll get the other $2.50 plus my $100 back. So I have a bond and I lent it to the US government. I lent money to the US government. Now, all of a sudden, let's say that so currently 1-year interest rates are 5%. That's the going rate. All of a sudden, interest rates go to zero. The same day I bought the bond, interest rates go from 5% to zero. And I have this piece of paper that says the US government owes me $2.50 in 6 months, $2.50 a year from now, and $100 a year from now. Well, someone else may say, Mike, I'll buy that. That's a great deal. You're earning 5%. If I buy that same bond, I would give them 100 today and I'd get back 100 tomorrow. So they may say, would you be willing to give me that bond and I'll give you $105 today? And you can do the math, but the gist of it is if I sell them that bond and those bonds are tradable, I will have lent $100 and I'll get $105 back today, assuming I sold it for $105. Now, the person that bought the bond from me paid $105. So essentially, they lent the money to the government at $105. They're going to get their 2 checks for $2.50, and then they'll get $100 back. So when you work through the math, they're lending $105 and they're getting $100 back, so they're losing $5, but then they get 2 checks for $2.50. So the yield is zero in that case. And so there's 2 components. When you're buying a bond, there's 2 components to it. There's the coupon, the $2.50 that we're getting twice, and then there's the yield. And that's the way, that's what's constantly changing. And the coupons never change. It's the prices that change to reflect so that those coupons equal the yield, essentially.
This gets confusing very quickly because it's basically math. But the important thing is that, when you're buying a bond, the coupon is one thing. And we do see this quite often. People will look at a bond like, oh, I bought this bond the other day. It has a 6% coupon on it. And, well, what did you pay for it? Well, I paid $106 for it. It's like, okay, well, your yield is zero. And they're like, what? I don't understand that. But this has a big impact ultimately on, when we're taking a look at bonds and how this fits into a portfolio. And particularly now, I think this has really gotten a lot more attention lately than before. When interest rates at a zero, nobody was really paying much attention to bonds. All of a sudden, as interest rates are going up, 4%, 5%, 6%, whatever, all of a sudden it makes a big impact because as interest rates go up, it has a big impact on the economy because of all the debt within the economy, right? Mortgage debt, corporate bond debt, personal debt, housing debt, treasury debt. All of a sudden, people are starting to recognize that higher interest rates mean higher payments, but they don't really understand how this is impacting the bond market. And as I was mentioning, and if we take a look at the bond market, and again, it's always interesting when we talk about the stock market, we talk about these big bear markets, right? So 2008, stocks were down 50%. And if you look back and say, man, if I could go back in time, I'd just buy all the stocks I could right there at, November, December of 2008, I'd just load up on stocks. But at the time, nobody wanted to buy stocks, right? Because we're in a major bear market. Everybody assumes that stock prices are going to go to zero effectively. And so nobody wants to own stocks at the bottom of the market. Interestingly enough, the bond market this year has had one of the biggest bear markets since the late 1700s. And nobody wants to buy bonds because of this big drawdown in price. But what's happened with bonds, and there's a huge difference between stocks and bonds. And this is one of the most important takeaways of our conversation this morning. If I buy a bond at maturity, I get my money back plus my interest payment, regardless of what happens with the price in between today and the date it matures. If stocks go to zero, stocks are at zero, right? You get that, they don't come back. And, the big difference between stocks and bonds is that return of principal function at maturity. And so interest rates have been going up. People are owning bonds. They're going, oh my gosh, I'm losing all this money in my bonds. But they forget about the fact that unlike a stock, a bond repays its full principal value at maturity, assuming it's not a corporate bond and the company went bankrupt, right? And so, it's important to make sure that you have good credit quality in your bonds. That's a different conversation. But, the important thing to take away from the conversation this morning is the big difference between stocks and bonds. Stocks do not have a guarantee of repayment in the future. Bonds do. Mike, your comments?
I would add one thing to that. What are yields? Yields are the price of money. Money drives the economy. What is the price of a stock? It's the price of an asset. The price of Apple or IBM or Microsoft doesn't drive the economy. It doesn't really affect the economy. If Apple's trading at 100 or 200 or 400, the economy doesn't really change. If the price of money changes from 1% to 3% to 5%, it has a massive effect on the economy, on global affairs. So you're dealing with two different animals, and the price of money is probably one of the most important things in a free market, in capitalism. And that's why we're paying very close attention to the price of money or bond yields.
The next part of our conversation here will be on why bonds are likely to outperform stocks by a fairly large degree over the course of the next 12 to 24 months, and we'll explain that why when we come back from the break. Investing in bonds. Why would you want to do that? I was asked a question recently on a podcast that if I had a choice of one investment, I could only buy one thing, right? For both inflation and deflation, what would that asset be? And I said, simple, I'd buy treasury bonds. And they kind of looked at me funny and they said, why would you buy bonds in an inflationary environment? I said, well, because during an inflationary environment, interest rates are going up. So I buy short duration treasuries. I buy 3-month, 6-month treasuries as interest rates go up. And as those bonds mature, I can just keep laddering up my bonds until I keep getting a higher and higher interest rate. So my interest income is continually growing in an environment. And of course, in a high inflationary environment, stocks aren't doing well, right? So from an asset protection standpoint, I can continue to grow my money. And as we said before with bonds, the great thing about bonds is that in 3 months or at 6 months, those treasuries mature. I get all my money back and I can invest again. Now, during that process, as Mike was talking about previously, is that as interest rates are going up, the price of that bond is going down. So it looks like I'm losing money on my bonds as interest rates are going up. But again, the difference between stocks and bonds is that at 3 months or 6-month maturities, when those bonds mature, I get all my money back regardless of what the price was, even just the day before maturity. So that's why I would own bonds in an inflationary environment. Now, why would I own bonds in a deflationary environment? Because, well, once interest rates get to a peak that something breaks in the market, I now have a high interest rate on that bond. And so I now want to move out to longer bonds. I want to buy a 10-year treasury because now I get a very high yield on that bond, right? And prices are very discounted. And most likely at this point, we're in the midst of a bear market and a recession in the economy. And this is where I want to lock in the most protection I can get. So in a deflationary environment, yields start to come down because there's a very high correlation historically between inflation, economic growth, and interest rates. And this makes completely logical sense because as we talked about in the last segment, Mike and I are we're creating a bond between us. He's going to loan me money, and he's going to loan me money for a certain interest rate. Well, what we didn't talk about was what does that interest rate encapsulate? What does that interest rate mean? So if Mike and I agree to a loan and I borrow money from Mike I borrow $100 from Mike and he says, okay, I want 5%. Well, where did he come up with that 5%? Well, that yield has to cover a whole lot of aspects of the economy. And as a bond investor, and I will let Mike explain this to you a little bit more, as a bond issuer, right, or as a lender, or, if you go to the bank and the bank loans you money, that interest rate is fixed for a period of time. So that interest rate has to cover a lot of different aspects of the economy. So Mike, when a bank is loaning me money for 30 years for a mortgage or 10 years for, something else, or 7 years for an auto loan, the bank's got to take into a lot of accounts about what they expect out of the economy, what is going on in the world, because they don't get to change that rate midstream, right? I mean, they're
Right.
locked into this coupon. And so this coupon has to reflect a lot of different aspects of the economy, right?
Right. So let's unpack that 1-year loan that I made to you at 5%.
Right.
How did I come up with 5%? Well, the first thing I'm going to think about are, what are the odds that Lance doesn't pay me back? And in theory, I probably should have charged you 50% because it's a 50-50 proposition here. But let's say I think those odds, the 3% odds that Lance won't make good on the money. So right off the bat, I'm going to charge 3%. Now I say, okay, I've taken a risk out of it. Now the question is, I can keep the money and buy something today, or I can lend it to Lance and buy something a year from now. So what's the rate of inflation going to be? I want to make sure that I'm made whole, that if whatever I want to, let's say we have 3% inflation over the period, if I want to buy, the newest, pick something, Lance, the newest video game for $100, and there's going to be 3% inflation, it's going to be $103 a year from now. So a year from now, I want 105 or 106 or whatever it is. I want to be compensated for taking risk by giving Lance money, and then I want to be compensated for inflation. Now, inflation, if we assume Lance is risk-free, so let's assume Lance is now Uncle Lance or Uncle Sam. So in theory, there's no risk with lending to the U.S. government. They can always print money. So we can take that risk premium out. Now it's just a function of inflation. Am I compensated properly for inflation? And that's where the economy comes in. The stronger the economy, the more inflation you tend to get. The weaker the economy, the less inflation you get. And this is where the Fed comes in, and the fiscal side of the government. The more spending, the more QE, the lower rates are, the more inflation you tend to get, and vice versa. And this makes the case for bonds today. Right now, what's really interesting is that inflation expectations, and this isn't what I expect or what Lance expects or what Jerome Powell expects. This is what the markets expect. Markets, this isn't polling people. This is based on where certain bonds trade, such as TIPS, inflation-protected bonds. And from that, you can deduce what the inflation expectation is. Now, what's fascinating is inflation expectations have been falling throughout the year. Inflation has been started to fall. It's not doing what inflation expectations are doing, but they've been falling throughout the year. And again, we're looking at 5 and 10-year periods, not what it's going to do over the next 3 months, right? Because we're going to lend money for Lance for 5 years. I want to know what inflation is going to be for the full 5 years. Those inflation expectations have been falling. The economy is weakening. We know we had negative growth in the first 2 quarters. And what really scares me is that the effects of all those rate hikes and all the interest rates going up take a long time to affect the economy. We really haven't seen that. The hurricane is still offshore. We're getting battered, we're getting winds, we're getting rain, but the eye of the hurricane hasn't even hit. Those big rate increases are only 3 or 4 months old. So the economy will weaken. That's pretty much baked into the pie right now. As the economy weakens, inflation will come down probably even more so than was expected. So we're dealing in an environment where you can then figure out what we call the real yield. Now, I know I'm bringing up a little jargon here, but what real yield is the yield that I expect to return after inflation. So if I lend Lance $1 for a year and inflation is 2%, Lance pays me 3%, my real expected yield is 1%. He's going to pay me 103. I can go buy whatever I was going to buy for 100 for 102, and I'm going to make $1. And I'm being incentivized to lend money. I'm being rewarded, and that's the way it should work. Again, Lance doesn't have any risk that I have to compensate for. So right now, real yields are the highest they've been in 15 years. The real yield on the 5-year Treasury, on a 5-year bond, 5-year U.S. Treasury bond, is about 1.6%. For the better part of the last 10 years, that has been negative. So if you buy a 5-year bond and inflation expectations perfectly match inflation, which they won't, but if they do, you're going to earn an additional 1.6%. And going back through history, that's a very high real yield, but that's also one reason why it's going to have a very negative effect on the economy. Because again, the price of money is trading at that kind of premium to the rate of inflation.
If I could buy something in an inflationary environment or a deflationary environment, I can only buy one asset. Why would it be bonds? When we come back from the break, I want to talk about another question I just got recently, which is, at what point do you buy stocks? And this is an important question as it relates to owning bonds and why you should be looking at buying long-dated treasuries, well, sooner rather than later, because of this potential hurricane effect that, and again, it's a terrible analogy with what's going on right now, in Florida, but this hurricane effect on the economy, as Mike was talking about, these interest rates are coming up, but they haven't impacted the economy yet. So the eye of the storm is still coming in. And so that's going to have a big impact on a lot of the equity side of the ledger, which is why bonds become much more attractive, particularly when bond prices have declined so much this year. So when we come back from the break, and it's going to be an important discussion as it relates to portfolio management and risk management, because as is always the case, there are times to own certain assets. And psychologically, the problem for investors is that, most times in history, when you have an opportunity to buy an asset that is undervalued or cheap relative to another asset, it's typically the time that psychologically investors don't want to own it because prices have come down, they feel like they're losing money. But again, there's a huge difference between owning bonds and owning stocks, and we'll talk about why now is probably one of your best opportunities in the last decade to buy bonds. One of the aspects of fixed income bonds in terms of a portfolio structure is that it provides a lower risk, or what we call a lower volatility asset to a portfolio. But that doesn't mean that prices can't go up or down in fixed income, just like they do in stocks. And again, the big difference between a stock and a bond, and again, extracting the risk of bankruptcy out of the equation for just a moment, is that if a stock goes down and a company runs into financial trouble, a stock can go, and has gone to zero. I mean, we can talk about Enron and WorldCom and a whole variety of other companies that have gone bankrupt over time. A bond, particularly a treasury bond, which is what we call a risk-free bond because the government can print money to pay for it, doesn't go to zero. It may go down in price, but it will never go to zero, and it will mature at face value. The one beautiful thing about a bond that people forget is the day I buy a bond, the very moment that I buy a bond for a portfolio, or Mike loans me $100, he can calculate to the penny exactly what his return will be a year from now, 5 years from now, 10 years from now, 30 years from now. If I loaned money to Mike for 30 years, I can calculate to the penny exactly what my return will be over a 30-year period, assuming Mike pays off the debt. Can't do that with an equity. If I buy an equity today, it's a complete guess as to what my return will be in the future. Could be great, could be terrible, but that's the way investing works. And so while investors talk a lot about buying stocks and wanting to invest in markets, one of the best investments you can have long-term if you really want to truly build wealth is owning bonds. Now, it's not nearly as sexy, not nearly as fun, but you will never lose money investing in bonds, again, assuming you do it correctly. And that's the beautiful thing about bonds. One of the questions that is coming up a lot lately is what happens next, right? So here we are, we're in the middle of this bear market in stocks, and Usually when you have a bear market in stocks, you also have a bull market in bonds, right? Because money's moving from risk into safety. And that hasn't been the case this year because very differently to what we've seen here over the last decade or so for most investors that have been in the market, is that we have inflation that we haven't had before. And inflation, as inflation goes up, yields go up. As yields go up or interest rates go up, bonds come down in price because the price of the bond is compensating for a higher interest rate environment, a higher yield environment, a higher inflation environment. But that also means that there's an opportunity coming because if you get into a deflationary environment, which would be caused by a recession, an economic crisis, or something like that, all of a sudden inflation is falling very sharply, yields come down, and when yields come down, bond prices go up. And so when you start looking at, asset classes, where do I want to be invested, particularly if a economic recession or something occurs in the United States in the next year or so? Well, that would dictate that I would want to own longer dated bonds in my portfolio. Why? Because today I buy the bond that has a very low price, has a high yield, so I can put income into my portfolio immediately. And if inflation and interest rates come down, the further I'm out in terms of years to that maturity, the greater sensitivity price has to that falling inflation. So the price increase I will get in the bond as inflation comes down and as yields come down, the greater the move that I have in terms of the price of my bond increasing in value because of that. And so this provides an opportunity for investors to make a trade in the portfolio that gives you a greater return on money, because what's happening to equities at this moment? If an economic hurricane hits and you have some type of financial event, a crisis event, or just a really bad recession, what's happening to equity prices? Right? Equity prices are having to come down. Why? Because earnings are coming down. Earnings expectations are coming down because of slower economic growth. So this provides an alternative in the portfolio to buy something now, but at some point that trade will also be over and there'll be an opportunity to buy equities again. And Mike, this is something that you and I talk about a good bit. Is Steve Druckenmiller just came out today talking about a 2023 recession, something that we've been talking about here a good bit over the last couple of months. In that recessionary environment, stocks are going to have to reprice a good bit. Bond yields will come down, prices will go up, but there's going to be some really great opportunities in fixed income and then alternative fixed income classes as we go through that recessionary environment.
Right. So why do we like bonds or prefer bonds over stocks at this point? Well, the Fed is essentially manufacturing a recession. I think some natural forces are also pushing towards recession too. But remember, we said that the Fed and all the rate hikes that they've done already take a long time to really be felt in the data. So there's an economic hurricane coming ashore. It's going to be really hard for a soft landing, as the Fed keeps trying to sell us on. The more this goes on, the more the Fed stays aggressive, the harder the economic landing. So again, we're looking at a very poor economy, recession, maybe a deep recession. We still have to wait and see. But the odds are growing every day that this economic hurricane is getting closer and closer. So what does that mean? Well, as the economy weakens, prices should go down. Inflation should drop. That makes the yield on the bonds look better and better every day. Now, at the same time, corporate earnings, which are driven off of the economy, will become more and more problematic. It's going to be harder for companies to meet their earnings bogeys because the economy is slipping. Then you add some dollar strength to that, and that affects companies even more so. So we're looking at two asset classes, one that benefits from a weaker economy, from lower inflation, and one that doesn't benefit, that gets hurt by a weaker economy and reduced inflation. And that's essentially the bet we're making. And why do we always talk about the Fed? Because the Fed is the puppet master behind this whole thing. They're the ones raising rates. They're the ones refusing to step aside. Now that we're seeing some economic pain, now that we're seeing some liquidity issues in England, in Japan,
The Fed is not backing down. The Fed is trying to get inflation down. The only way to get it down is with a good old-fashioned recession. They know that. They're not mincing words at this point. What we've been talking about for years is we're following the Fed. We're doing what they're telling us they're going to do. If you think that we're going into a recession, if you think inflation is going to come down in part because of the recession, in part because of just normalization of all the supply-demand problems we've had over the last few years, bonds are a steal here. And at the same time, stocks are questionable because, again, we're going into a recession. Their earnings estimates are going to have to come down. Their earnings are probably going to be lower than we expect. Regardless of whether you think there's going to be a recession or not, you have to play those odds. Where is everything going now? That could change in 6 months. The Fed could flip-flop tomorrow, and our view could flip-flop tomorrow. Mm-hmm. But right now, everything is telling us we're headed for a recession. We're headed for lower inflation. And if you're choosing between stocks and bonds, the winner is somewhat obvious. But again, the Fed can change stance quickly. And that's why we pay attention to every word out of their mouths and their rhetoric and their narratives and what they're trying to relay to the markets.
Yeah, I think the point about how the Fed could flip-flop in a moment is important here because we're mostly talking about buying individual bonds for a portfolio, but you could also buy a bond ETF to accomplish the same thing. When you're talking about trading, the problem with ETFs and bond mutual funds, which are okay to own for a trading purpose, they do not supply the return of principal function that an individual bond does. So there is a difference between bond funds and bond ETFs and individual bonds. We're talking specifically about owning individual bonds here, but for a trading purpose, we're also talking about buying bond ETFs here as well. So when we're looking at adding exposure to a portfolio, because yields are extremely oversold here and bond prices are very oversold, and if we're looking for a trade or a hedge in the portfolio, a bond ETF will work just fine for this. And so we'll be looking to add to our TLT position here over the next few months. But importantly here, if the Fed flip-flops, that means that something has now broken in the economy. They're not going to start dropping rates and doing QE if everything is just fine like it is now, right? They're going to keep raising rates and combat and reducing their balance sheet. So when they begin to flip-flop, immediately what will happen is that money will start to flow into treasury bonds for safety because something has now broken in the market, and there will be a reversal in Fed policy to try to combat that problem. Go look back at March of 2020 as a good example. The Fed started implementing all types of policy action, and markets were still falling while they were initially doing these actions. And then finally they gained traction in late March as QE really started to take effect. So stocks will be coming down as the Fed flip-flops on policy. But then when interest rates start to get back to zero on the Fed funds rate, that's where you'll sell your bonds, take the capital appreciation out of your bonds because interest rates can't go below zero. And then that's where you start looking to buy distressed assets, broken equities, convertibles, preferred stocks, those type of things, because as you're coming out of the bear market, you'll want to own equities over bonds. So again, it's all part of the portfolio management process and risk management as well. That wraps up the show for the day. In the meantime, get by the website. Our latest newsletter is out. Mike's blog post up on the website as well, realinvestmentadvice.com. Have a great day.